Hi, and thank you for joining us here at Tax Talk UK, where we talk about all things tax and consider other important aspects of working for yourself, being self-employed, running a small business. So today we're going to talk about cash accounting for sole traders. And before I start on that, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you should need to, as well as being able to find other information that we have available on a whole host of topics, all aimed at supporting you in your self-employment. All of our videos are catalogued in our playlist. So if you go to the playlist section of our channel and you look for the scenario that describes you, and then in that playlist you will find the information that is relevant and aimed at supporting you personally. Thank you. So on then to cash accounting. So we've talked before about cash accounting for VAT. So it's all a similar concept. But today we're talking specifically about how you actually keep your accounts, and not to do with VAT especially, but your whole accounting system. So cash accounting then, so firstly to mention, if you are operating as a limited company, then you cannot use cash accounting for your day-to-day accounts. You could still use cash accounting for VAT, and that's not what we're talking about today, but I don't want to cause any confusion, so I just want to make that clear. So if you are a sole trader and your turnover is less than 150,000 per year, then you are able to compile your accounts using the cash accounting system. And quite simply, all that means is that rather than basing your accounts on your sales invoices, your purchase invoices, calculating your liabilities and your assets, you're simply accounting as the money comes in and out of your business. So if you are using Making Tax digital software, then this is really easy to do, and we'll keep things nice and simple for lots of people, where you can just have your bank feed connected to your Making Tax digital software, and then the transactions feed through, and then you simply allocate to say, yes, that's a sale, that's for this, that, or the other, depending on what type of expense it is. And that is simply what cash accounting is. So it can be good if your business is very simple, very straightforward. You don't have lots of assets or liabilities that you need to keep track of. So it's very simple. Then the problems arise if things aren't so stable, or if your customers don't consistently pay you to the same terms. So obviously one of the principles that we're trying to achieve when we look at accounts for the period is that we're trying to match up the sales and the cost of those sales and the expenses that went towards making those. So as if to imagine that you just traded in isolation for that one period of time, and all the sales and all the costs that related to it fell in that period. So we do, as we've talked in other videos, a series of adjustments to make that happen. But also by default, even without the adjustments, if we're working on a traditional accounting, then we would be accounting from the sales and the purchase invoices. So it would be not relevant to the profit and loss, whether they've paid or not. And of course, by not making those adjustments and not making a true and full reflection of the accounting period, it can skew. So it can mean that one year's artificially high profit and another year's artificially low, just because the adjustments weren't made And it could be that actually in reality, both of those years were exactly similar in their profitability, but by not making some adjustments, one year looks high and one year looks low. So that can be problematic if you are looking to support lending from your income, for example, because a lender will want to see consistent levels of income. It can be problematic when you're trying to assess the financial health of your business. So if you imagine that if you're using the cash basis and you're literally accounting for the money, effectively your profit and loss is going to track your cash flow, which of course those are two very different things ordinarily. So that may mean, for example, if one year a whole load of your customers are late paying you, and it goes into the next accounting period, then that in itself would skew your account. So it's a very simple system. It's a very simple way of keeping accounts for very simple businesses. The turnover, as I mentioned earlier, must be under 150,000. But it's important that if you are using cash accounting for your accounts, that you understand the implications and of that to be able to understand whether it's right for you or whether you should be using traditional accounting, whether that would be better for your actual business. But certainly if your business is very small and very simple, and it's a great way of keeping the accounting side of things nice and straightforward for you. So and just to clarify again, just to mention that we're talking about cash accounting for the actual account. So it's separate from cash accounting for VAT. So you could do traditional accounting for your accounting records and cash accounting for VAT. They're both completely separate. When we're talking about cash accounting for accounts, that is only available for sole traders and partnerships. Limited companies cannot do that. And as I say, it is important to understand, just to get your head around the implications. Even if you decide that it is the right thing for you, it's important to be able to do that you understand what's happening by doing that. So thank you very much for watching. If you haven't already, please do subscribe to our YouTube channel. Thank you. Goodbye.